I think we do need to be quite cognizant of what we're giving up in exchange for this dramatic inflow from ETFs and corporate treasury adoption and things of that nature. But, I think that's where DeFi really comes in, and we're seeing a lot of innovation happening on the front.
Hey everyone, this is your Markets Outlook. I'm Jenn Sanasie, joined by my co-host Andy Baehr. Our guest today is co-founder and CEO of Arch Network, Matt Mudano. Hey, Matt.
Hey, how's it going?
Not bad. How are you doing today?
Doing well. Bitcoin's back up, so it's always a good day to see a green chart.
Bitcoin is back up. And so let's start there. I know that your price target is 150 by the end of the year. Talk to us a little bit about what it's going to take to get there.
I think there's a lot that's going into it. Obviously, we're seeing a lot of a structurally tighter market, I would say, as a result of a lot of the ETF inflows, a lot of these sovereign wealth funds, and I guess general more institutional adoption than historically speaking than we've seen in the past. And that's, of course, led to more bullish price action. And with a lot of this like gobbling of the coins in the public markets, I think you're going to start to see a lot of the supply tightening up here in the last quarter, and that should translate to some positive price increase going into the last quarter. Obviously not financial advice, but we're bullish.
You've been watching Bitcoin a long time, and that gives you a great unique perspective. And Bitcoin's volatility has come off quite a bit. I think probably people who watch Bitcoin a lot and think about a broader adoption set aren't too surprised by that, but lower volatility can sometimes mean a little bit less urgency for fees, and certainly for some fewer trading opportunities. I was looking at 1 month implied vols are below 30 today for Bitcoin, which is pretty incredible. How do you think about Bitcoin's declining volatility versus price action versus the environment for fees and for miners?
Yeah, I mean, I think it implies that there's a lot more sophisticated market structuring that is in the market, so that you have some sophisticated price floors that are there, right? And like you said, that could be good for price action, right, which makes the price go up, but maybe not so healthy for the profitability of miners, which are ultimately safeguarding the network and its decentralization, which Bitcoin has been known for, and most people love about it. So by a lot of these ETFs sucking up a lot of the liquid supply in the market and taking it off chain and putting it in cold storage, it doesn't introduce a relatively interesting, double-edged sword, so to speak, because the more Bitcoin that we take off chain or into other ecosystems like Ethereum and Solana, that is much less opportunity to be moving Bitcoin around the base layer. And that is what ultimately creates a dynamic fee market for Bitcoin block space. And that's how miners ultimately get paid, especially as the Bitcoin, issuance and rewards keeps getting reduced as future happenings start to occur. So I think we do need to be quite cognizant of what we're giving up in exchange for this dramatic inflow from ETFs and corporate treasury adoption and things of that nature. But, I think that's where DeFi really comes in, and we're seeing a lot of innovation happening on the front.
Matt, take that a little further for me. For folks who are just starting to become interested in Bitcoin, maybe they're retail investors, they're buying Bitcoin on an exchange, maybe they're interested in the ETF. Why do they need to care about miners' fees? Why do they need to care about this level of the Bitcoin ecosystem?
Yeah, that's a great question, because I think a lot of people, especially new adopters that have seen Bitcoin in the headlines more recently and finally started to take a little leap of faith and starting to get some exposure in their personal portfolios, what they may not understand exactly why people would, like Bitcoin or trust Bitcoin. And the short answer is because there's no one with their finger on the trigger or on the button that can say, hey, let's just issue another 21 million coins this year because we need to pay those miners. The miners aren't happy. So the fact that there is not one person and it's properly decentralized and no one can control it, that's why everyone trusts it. The fact that it is decentralized in this sort of way means that someone's got to pay to keep the lights on. And that's what these miners essentially do. They create this element of decentralization and nobody having a single authority over Bitcoin, the asset, or the network in general. What they do is they're running these algorithms using these machines that consume electricity. And every single time a Bitcoin block is found, they get paid, the miners get paid. And as time goes on, as more Bitcoins are found, there's a reduced amount of free Bitcoin that is paid to these miners. So then the question becomes, okay, what happens after all of those Bitcoins are found and there's nothing to pay those miners with? How do they keep the lights on? And that's the billion or $1 trillion question right now is how do we keep the miners paid and happy? Because that's how ultimately Bitcoin remains safe and decentralized and secure. So as they become less profitable, which is currently what you're seeing, because there's not a lot of demand right now for on-chain Bitcoin DeFi, mostly happening off-chain in other places and using ETFs in the public markets and so on and so forth. The miners are having a harder time staying profitable. So the smaller and more medium-sized miners are going to be the first to go. The publicly traded ones that can absorb losses a little bit easier, will stick around. But that over time will make Bitcoin a little bit more centralized, and that compromises what's good about it. So in order for us to maintain the long-term goodness about Bitcoin, we have to focus on how are we actually going to keep the miners happy and paid. And the only way to do that is do more things on chain with it.
That's a great theme to pick up on because you kind of almost have cross currents, right? The more successful Bitcoin becomes. And even if you maintain, I guess, a core Bitcoin philosophy of you buy and you never sell, right? Whether that's in a corporate treasury, an ETF, or in an 11-year-old dormant wallet holding 80,000 Bitcoin, right? Those are Bitcoins that are not moving from one address to another, and they're not paying fees to the network. So that's not necessarily at odds with Bitcoin's philosophy, but at the same time, you need incentives to remain. And I guess that's where Arch comes in as a way to solve technology problems, but also try to replace or at least let those incentives continue to breathe over long periods of time in a way that doesn't interrupt the store of value concept for Bitcoin. Is that a fair way to summarize where you've taken this?
Yeah, I mean, it's an incredibly compelling paradigm, right? When you think about it from the Maxi perspective, like you were mentioning, where the ethos has been, don't touch those coins, just stack them in cold storage and keep them safe.
Yeah, I wasn't using the right lingo, but thank you for, I forgot the other words for every word we have in traditional finance. But yeah.
And maybe some may not appreciate, the nomenclature or something, or being put in that box. But it is interesting because those same Maxis also really appreciate the decentralization and the nature of trustlessness that Bitcoin has. So if that ever becomes compromised as a result of the core ethos, which is put it in cold storage and just let it sit, where is it ultimately going to land? And I think that's what you're starting to see in the market right now. Is you're seeing the paradigm shift quite a bit into this more trustless Maxi, into more of a yield Maxi, where now it all comes down to how you can make this asset perform and find yield. And the only way, and the answer to that is of course, doing more DeFi native things and making the asset more productive and building more things around this monetary asset, which is of course the next phase of evolution for any monetary asset, doing more things with it, borrowing, lending, and structured products and things of that nature.
Midnight is a privacy-enhancing blockchain, introducing vital, programmable privacy and selective disclosure capabilities. It means dApps can allow users to control what information is revealed without putting sensitive data on-chain, allowing you to break free from the limitation of choosing between utility or privacy. We deserve more when it comes to privacy. Experience the next generation of blockchain that is private and inclusive by design. Break free with Midnight. Visit midnight.network/breakfree.
Matt, how do you think about getting people to understand this and at the next level, getting people to care and want to interact with decentralized applications that are built on blockchain? Andy and I were talking before the show, we were talking about all the other chains that are already programmable, that have dApps that work on them, that are getting a little bit more mainstream attention right now. How do you get people to care about that in the Bitcoin ecosystem when that narrative really is, Bitcoin is digital gold, you buy it, you hold it forever, all that other fun stuff I want to do. Maybe I'm going to do it on the base app on Ethereum.
Well, the first question you asked was, how do you get people to understand? And I don't think we need to help them, wrap their heads around how DeFi works necessarily, because we've seen Ethereum and Solana and many, many other blockchain ecosystems form up over the years. So I'm a firm believer in saying there's nothing new under the sun. There's going to be a lot of similar ideas and notions that happen. And that's kind of where things have really come full circle is, Vitalik left the Bitcoin world to go start Ethereum because he realized there was this gap in programmability and utilizing blockchain infrastructure to be able to build these decentralized financial applications. But back then, we didn't have the same type of things and dynamics that we have on Bitcoin today. We've seen a few upgrades to Bitcoin's core stack, like the Taproot upgrade, which allows us to do more native things on Bitcoin where we can store data and do more of the primitive things that are foundational to DeFi on Bitcoin that wasn't available back in 2017. So I think that you have a lot of these dynamics where Bitcoin is now ready for it, both in terms of technology and just broader, adoption by the rest of the world. How they ultimately, learn about it, well, they already have a playbook to follow, right? Ethereum and Solana have already done it quite well and scaled DeFi there. How to get them to care about it? Well, I think that that's really a matter of this paradigm that I keep talking about shifting. I think people are a little bit less patient with speculative coins, these altcoins that have largely failed to justify their existence over the last 4 or 5 years across cycles. And Bitcoin is the asset that everyone really wants, right? They want to hold it. They want to get more of it. And now they want to earn yield on it because that's how they ultimately earn more of it as it gets more and more expensive. So we've sort of learned from all of the advancements in DeFi on Ethereum and Solana. So now we can take all of those things that we've learned and bring it back to Bitcoin, where that's the hardest money, but there's no native apps. And that's the big opportunity, the big unlock.
This is fascinating stuff. To build on Jenn's point and your response, I guess your objective is partly at least sustainability for the Bitcoin network, right? And the security around it. And then you have the application of DeFi on the Bitcoin blockchain, which should increase activity and should sustain fees over time. Presumably that DeFi activity has to be competitive with other DeFi platforms, or people won't use it, or they won't have the right incentives to use it. I guess my question is, do they even have to know, right? If I have Bitcoin sitting in cold storage behind an ETF or in a wallet at home, can I just continue to stack my Bitcoin knowing that somewhere back there, there's activity going on to help prompt more activity, which will help create better sustainability? But to me, that's just, okay, fine, that's whatever, but that doesn't change my reason for ownership. Or are you also trying to provide more benefit to me as a holder in terms of things like yield endemically? Because I do think that it took a long time to get traditional investors to appreciate the Bitcoin store of value concept. Making that more complicated right now and adding nuance to it may or may not be helpful. Just wondering if all of this can happen in the background with a competitive DeFi environment and incentives that are within the Bitcoin ecosystem, but don't really have to end up being known firsthand by the end investor.
100%. No, I mean, I think that's, the next big frontier in crypto and in terms of user experience is abstracting away the complexities of Web3 and blockchain so that the end user doesn't really know that they're interacting with it at all. And that's where a lot is left to be desired in terms of user experience. And with regards to Bitcoin, is it has probably the worst user experience of all crypto assets, even though it's the hardest of money. And that's because Bitcoin itself is very clunky, it's slow, it's intentional in the way that it's designed to optimize for security and uptime rather than for performance and expressivity. And that's what ultimately requires a network such as Arch to allow developers to have a little bit more predictability out of building with Bitcoin, but building applications around it. And it's interesting you use the word stacking.
I'm learning step by step. It's only been 3 years.
It's very similar to the whole Acorns idea. If you're familiar with the fintech concept, Acorns, but this stack now, pay later and stacking coins. But there's this app and it does not feel like blockchain or Web3 at all. In fact, the user case studies and surveys they've done, it really leans into the female 35 to 45 demographic, because it's something that just allows them to just add $1 or $5 on top of their Starbucks purchase to just DCA into Bitcoin over time. And they have absolutely no clue that there's any blockchain going on behind the scenes. But to them, it's just something that they're able to tap into and connect their bank accounts through ACH and with some Stripe or Plaid connection or something like that. But they're able to interact with Bitcoin and even earn yield on that Bitcoin as almost like a savings account, that they aren't really even familiar with the complexities of DeFi that are driving it behind the scenes. And then on the complete opposite side of that, you have the more familiar DeFi stuff like the borrowing, lending, looping, and leveraging type of protocols that whether you're a liquid fund or an individual investor, you can find use for.
All right, Matt, just before we go, I want to ask you about the financial future you envision. Where does Bitcoin fit into that financial future? And I ask you this, I was speaking to Kathy Wood recently, and she was telling me, you know, when she set out with ARK to set their Bitcoin strategy, they really saw Bitcoin as being used for peer-to-peer payments. Now, stablecoins obviously have taken that torch from Bitcoin. So where do you see Bitcoin playing when you look at the financial future that you're building towards?
I think Bitcoin will secure itself as internet-based yields. I think you have blue chip treasuries, you have ETFs, you have sovereign wealth funds that can all lend, stake, borrow against, and use Bitcoin for a variety of different things. And that's just going to be the international asset of trade in the future, in our opinion. And though you can do some of these things already on Ethereum with stablecoins and Ethereum, those assets aren't nearly as attractive as Bitcoin. If Bitcoin is becoming more and more accepted as a hedge against the decaying dollar, then why am I going to use stablecoins to do DeFi? I want to use Bitcoin as my unit of settlement. So I think that that's going to continue to be accepted over time. You'll see the fee market renaissance really come back on Bitcoin, unlocking and tapping into the unprecedented amount of MEV potential that exists in moving assets around on Bitcoin and reorganizing and reconstructing the transactions that move those Bitcoins around. So I think that opportunity is not really being talked about yet. So it's really going to bring back this whole fee market renaissance for Bitcoin as well, which is going to be an exciting thing to see as well.
Matt, thanks so much for joining us.
Thank you, Matt.
Thank you for having me.